You're entering the future-ready CNBC TV18 eBix Cash Studio.
Welcome back. Well, the market has not moved much actually, just a little bit here and there. Give and take everything, the Nifty and the Sensex are flat. Gives us some time to discuss the broader picture. Gautam Duggad, the head of research institutional equities at Motilal Oswal Financial Services, joins us now. They have, come out with a report where they speak about the important trends post the Q2 results, improving demand environment and impact of rising input costs on operating margins. So those are the two big takeaways. Gautam, welcome to the show. I want to first start with the paint sector because we just spoke to, the management of Indigo Paints. We heard from Asian Paints as well. The feedback we're getting is that demand is rock solid and they can pass on this price increase to customers. Is this still a space that one can sort of put money to work in?
Hi, Sonia. Good morning. Yes, as far as paints is concerned, clearly the structural factors that drive the paint growth in India is as relevant today as it was a decade back. And we all have seen how the last 10-15 years Asian Paints is done. Historically, it has proven to be a good opportunity to buy whenever there has been a disappointment in the quarterly earnings thanks to raw material prices or higher discounting. So I will take that, as an opportunity to buy. Clearly, over a period of time, they've demonstrated sufficient pricing power. This is an oligopoly. There are 4 players who control roughly 75 to 80% of the market share. And typically, Asian Paints leads the price, changes, which we have already seen in the last 1.5 months. They've taken almost a double-digit price increase. Maybe third quarter may not be the best quarter to look at from a margin point of view because these things tend to take time before they reflect in the P&L. But over a period of time, they've always demonstrated their ability to pass on the input cost inflation to the consumer without taking a significant hit on their volume growth. And demand commentary for all the 4 players, or now 5 players, have been fairly strong going into the festive season for the second quarter FY22. And in general, we are seeing a very upbeat sentiment in the consumer sector. So, yeah, valuations clearly are expensive. So, therefore, this is a sector which is more suited for somebody who has a long-term orientation.
Okay. Good morning, Gautam. First of all, congratulations on a very interesting report. Some interesting trends, number of upgrades, downgrades, 1:1. And I think you'll have not increased or decreased the year-end EPS either. It remains at 730, isn't it? For the EPS. Just tell us, what are the trends you learned from Q2 that has altered your look at future purchases in terms of stocks?
So, Lata, for example, the quarter that has gone by, at the aggregate level, there is a significant beat versus expectation of 26-27% earnings growth. We've got about 37-38%. But if you dive deep into the numbers, you will notice that if you exclude 2 commodity sectors, which is metals and oil and gas, the growth is just about 12-13%, which is perfectly in line with expectations. To put it other way, almost 90% of the quarter's earnings growth, incremental growth, has come from just 3 sectors, which is metals, oil and gas, and PSU banks. We've also seen a significant hit on margins for sectors like auto, specialty chemicals, consumer cement, and consumer durables. So we have seen downgrades in some of those sectors, but they got more than offset by the upgrades that we have seen in oil and gas, some upgrades in tech and financials. So net-net, when we started the quarter, we were at an EPS of 730 and 874, and we ended the quarter exactly at the same numbers. Just that the internal drivers of the growth has shifted more towards cyclicals. If I look at, for example, FY23 also, then you have one change. Auto is expected to contribute in FY23 after staying absolutely flattish for the last 3-4 years. In fact, FY18, the peak earnings of the Nifty auto companies was 30,000 crores. We are ending FY22 or expected to end with about 17,000-18,000 crores of earnings. And then it is expected to do roughly 40,000 crores of earnings in FY23. So auto will contribute to the earnings growth. And then usual drivers, financials, oil and gas, and technology. These 4 sectors together, I think, should account for roughly 85-90% of the incremental Nifty earnings within FY23. So to that extent, our model portfolio is also tilted a little bit more towards cyclicals. So discretionary is something which we prefer, consumer discretionary. We have seen a very strong commentary coming in from jewelers. So clearly Titan, which has been a part of the model portfolio for 6-7 years, remains a number 1 preferred discretionary idea for us. Financials look to be a sector where valuations are quite reasonable. which is not something which you can say about a lot of the other sectors. The absolute underperformance that we have seen in financials and earnings has been fairly solid. So those two factors combined make the valuations and the outlook quite strong. So that remains an overweight for us. And we are also overweight on metals, cement and consumer as well. So that is where our portfolio is by and large concentrated towards. And of course, sorry, I forgot to add, which remains the single largest overweight position for us even now.
Gautam, you do know that we can go on and on discussing with you because it's really a pleasure interacting with you, but we've unfortunately run out of time. We will do this on another day. Thank you so much for joining us. That's the word coming in from Motilal Oswal. Let's slip into a short break. Up next,